Global markets are currently absorbing an acute energy shock, and the resulting supply chain friction is cascading through the economy. In the United States, the macroeconomic warning signs are clearly flashing. March data officially pushed the headline Consumer Price Index up to 3.3% year-over-year. Corporate supply chains are already feeling the heat. The March ISM Business Climate Index recorded sharp, simultaneous spikes in both procurement prices and delivery delays across the manufacturing and non-manufacturing sectors. This is the physical reality of the Hormuz tax. Geopolitical friction in the Middle East is actively lengthening global transit times and driving up the cost of raw inputs. Yet, despite these localized spikes and red indicators, the Federal Reserve is not signaling systemic panic or an emergency policy pivot. Instead, Chairman Jerome Powell and the central bank are holding steady, maintaining a highly restrictive wait-and-see posture. By deconstructing the underlying CPI data, we can identify exactly why this is an acute, isolated shock and map the three structural buffers currently insulating the U.S. economy. Understanding the mechanics of why the Fed has the luxury to wait is the critical prerequisite for financial leaders and investors allocating capital in the second quarter. To understand the Fed's posture, we have to separate the volatile headline inflation number from the underlying core index. This dual-axis chart maps the March Consumer Price Index. The 3.3% headline surge you see here is heavily driven by a direct pass-through of global gasoline and fuel oil costs. However, stripping out food and energy reveals a different reality. The core index sits at a relatively moderate 2.6%. The pass-through of those spiked energy costs into broader goods and services, including the heavily weighted housing sector, remains statistically limited. This visualization tracks consumer sentiment surveys. On the immediate timeline, 1 year ahead expectations from the New York Fed and the University of Michigan spike aggressively, peaking as high as 4.8%. But expanding the timeline to 3 to 5 years out shows medium-term expectations flatlining firmly between 3.0% and 3.4%. The Cleveland Federal Reserve's April nowcasting corroborates this stability, projecting core CPI to remain effectively flat at 2.56%. The granular data shows the market is accurately pricing the current energy spike as an acute, geometrically isolated shock, rather than a permanent runaway. The Federal Reserve can maintain its steady posture because the U.S. economy is protected by a unique three-part structural buffer. The first pillar of this armor is America's deep domestic energy independence. This chart tracks global versus domestic energy benchmarks. While West Texas Intermediate crude violently surges upward with global tensions, U.S. Henry Hub natural gas futures remain remarkably stable. This stable domestic pricing acts as a direct lifeline, exclusively powering U.S. heavy industry and manufacturing. By contrast, European and Asian manufacturing sectors face severe margin compression, as they remain completely exposed to those volatile global crude derivatives. This decoupled energy reality mathematically translates into a highly quantifiable 12 to 18-month competitive advantage for United States export markets. The second pillar insulating the central bank relies on foreign exchange dynamics. The relentless strengthening of the U.S. dollar artificially lowers the cost of imported goods. This dominant currency creates a deflationary shield, absorbing and offsetting imported inflation before it can fully permeate the domestic economy. The third and final pillar is the mathematical positioning of the Federal Reserve's own interest rate. This graph compares the neutral rate of interest, the theoretical point where policy neither stimulates nor restricts growth, against the current Fed policy rate, which sits comfortably above it. This spatial gap between the neutral line and the policy rate provides highly restrictive breathing room. Jerome Powell has the mathematical luxury to wait out the data, an advantage central banks like the European Central Bank or the Bank of Japan simply lack. Together, energy independence, a strong dollar, and restrictive policy rates engineer the armor required to absorb geopolitical shocks without triggering a long-term inflation spiral. With this decoupled reality mapped out, capital allocators and financial leaders must actively adjust their portfolios and supply chains for the second quarter. The first mandate targets institutional investors. Exploit the asymmetric divergence in global margins. Investors should actively overweight U.S. domestic industrials and manufacturing equities, moving capital away from their European and Asian counterparts. Insulated domestic energy costs secure a competitive export advantage, shielding these U.S. firms from severe margin compression. The second mandate applies directly to corporate finance and procurement leaders. Avoid panic pricing. Supply chain teams must avoid locking their organizations into long-term vendor contracts priced at the absolute peak of the current global energy shock. Instead, actively pivot sourcing toward North American suppliers, where energy inputs are safely tethered to the stable Henry Hub benchmark. The third mandate directs Treasury and fixed income teams to maintain strict short duration. On the Treasury yield curve, the timeline for rate cuts is pushed out by the Fed's wait-and-see luxury. Treasurers must utilize ultra-short duration vehicles for risk-free yield. Keeping capital in 0 to 6-month Treasury bills ensures dry powder remains ready for deployment once the geopolitical risk premium subsides. Evaluate your own ISM input prices against the foreign exchange cover in your supply chains. Ensure your organization is positioned to exploit rather than fight the U.S. macroeconomic buffer.